Have you ever seen a company where sales are just booming, everything looks great, and then all of a sudden it just goes bust? Yeah, it happens way more than you'd think. Today, we are going to look at a key financial ratio that's kind of like a company's check engine light. It's a tool that helps us see past all those flashy headlines and figure out how efficiently a business is really running. So let's get into it. Right? It's a total paradox, and it trips up even the most seasoned investors. You see sales climbing, the news is all positive, but underneath the surface, the company could be getting dangerously inefficient. That's the mystery we're going to dig into today, and our main clue is this really powerful metric, the asset turnover ratio. And this right here, is the heart of the whole problem. A company might be spending millions on shiny new factories, equipment, tons of inventory, but if its sales aren't growing just as fast or even faster, that is a huge red flag. An imbalance like that can be fatal for a business, which is exactly why we need a specific tool to spot it. So let's start piecing this puzzle together. The asset turnover ratio is our key. It's the one metric that really cuts through all the noise of those impressive-looking sales numbers to tell us what's actually going on with the company's efficiency. This is it. This is the simple but incredibly powerful question the ratio answers. For every single dollar a company has invested in its stuff, its assets, how much money is it generating in sales? So for example, if you see a ratio of 2.0, that means the company is ringing up $2 in sales for every $1 it has tied up in assets. It's a direct measure of how hard those assets are working for the company. Okay, so how do we actually figure this thing out? Let's break down the formula. It's pretty straightforward, but really understanding each piece of it is what unlocks its true power as an analysis tool. And here it is. Pretty simple, right? Net sales on top. That's the revenue from a company's main business. After you take out returns and discounts. It's the real cash coming in the door. And on the bottom, total assets, well, that's everything the company owns to make that revenue, from the cash in the bank and its inventory, all the way to its buildings and machinery. Now, you're probably wondering, wait, why average total assets? Good question. Think about it. Sales happen over a whole year, right? But the asset number on a balance sheet, that's just a snapshot from one single day. So to get a much truer picture of the company's efficiency over that entire period, we average the assets from the beginning and the end of the year. This is a super important step. It keeps a big last-minute purchase from totally messing up the numbers. So, you've done the math, you've calculated the ratio. Now what? Well, this is where the real detective work begins, because a number on its own, it's pretty much meaningless if you don't have the right context. And this is the absolute golden rule of using this ratio. You just cannot compare companies from different industries. Seriously, comparing the asset turnover of a retailer like Walmart to a gigantic utility company, it's like comparing a cheetah to a blue whale. I mean, both are amazing at what they do, but you just can't judge them by the same yardstick. It doesn't work. Just take a look at this. A retailer. They have a pretty small asset base, right? Mostly just stores and inventory that moves super fast. So for them, we expect a really high ratio. But a utility company? They have to build these massive, incredibly expensive power plants, which means their asset base is enormous. So that naturally leads to a low ratio. The key takeaway here is to only, and I mean only, compare a company to its direct competitors in the same exact industry. This is a fantastic question, and you should always ask it because it gets us into some really important details. It's so tempting to just think, oh, higher is better, period. But in finance, the answer is almost always, well, it depends. And here's the catch. A company could have a sky-high ratio simply because it's running its old, totally depreciated equipment into the ground. Yeah, it looks super efficient on paper today, but it's not investing in the new machinery it's going to need to compete tomorrow. So that high ratio could actually be hiding a huge problem, just waiting to explode. Okay, so this brings us to an even deeper level of analysis. The asset turnover ratio isn't just some number you calculate. It's a direct reflection of a company's core business strategy. And, broadly speaking, there are two main paths a company can take to be profitable. There's this really powerful framework called the DuPont analysis, and it breaks down profitability and shows this exact strategic choice. A company can either sell a massive volume of things for a tiny profit on each one, or it can sell just a few things but for a huge profit on each one. Just think about the difference between Walmart and, say, Ferrari. And you can see that trade-off right here. A discount retailer, they live and die by high asset turnover. They have to move that inventory like crazy because their profit margin on each can of soup or pair of socks is teeny tiny. On the flip side, a heavy machinery manufacturer is going to have a low turnover because its assets are just massive and so expensive. For them to succeed, they have to have high profit margins on every single sale. All right, now for the really fun part, the detective work. This ratio can give you some amazing insights, but there are a few common traps where the numbers can fool you if you're not paying close attention.
So, can they lie? Well, not exactly lie, but they can definitely obscure the truth. The accounting choices a company decides to make can dramatically distort this ratio, making a company look way more or way less efficient than it actually is.
Let's look at two of the biggest culprits here. First, there's historical cost. Assets get recorded on the books for what the company paid for them, maybe years or even decades ago, not what they're actually worth today. So an old factory could be on the books for just a fraction of its real value. Second, depreciation. Some methods shrink an asset's value on paper much, much faster, and both of these things can artificially pump up the ratio. The effect of these accounting choices is actually simple, but it's really powerful. Both of them shrink the denominator of our formula, that total assets number. And, basic math tells us that when you make the bottom number in a fraction smaller, the final result gets bigger. So this can create this illusion of high efficiency that just isn't grounded in reality. And this is it. If you remember one single thing from all of this, please let it be this. This ratio measures how good a company is at generating sales, not how good it is at making a profit. A company can be the most efficient business in the entire world at turning its assets into sales and still lose money on every single one of them. Efficiency and profitability are two very, very different things. So let's start to wrap things up with this thought. This quote really gets to the heart of it. It's not just about plugging some numbers into a formula. It's about using that formula to get a read on how well a company is actually executing its strategy and managing its resources, day in and day out. And that's really the ultimate takeaway. The asset turnover ratio is so much more than a calculation. It's a window into a company's operational DNA. It forces you to look right past those big headline sales numbers and ask what's really driving the business. How effectively does it turn its investments into actual results? See, it doesn't just show you what a company does, it shows you how well it does it.